Welcome to the Smart Investor Podcast with Portfolio Manager Beyond Dale, the show that takes the guesswork out of investing by bringing you actionable price analysis of the stock, ETF, Forex, and commodity markets. Here is your host, Beyond Dale.
Hello, everyone, and welcome to another edition of the Smart Investor Podcast, your source for higher profits with less risk in any market condition. I hope you all had a wonderful weekend. It's a Monday afternoon, and I hope the weekend was good. It was relaxing and peaceful. Looking at the markets today, we see that that stocks are down across the board, really. And we'll take a look at that. We'll also take a look at or speak about the feeling of missing out, because the market is rallying now generally, and there are a lot of investors that have missed a lot of this rally and are on the sidelines. So we'll speak about how to not miss out on some of these stock moves. We're also going to take a look at the broader markets. We'll look at gold, silver, oil, the Dow, Nasdaq, the FTSE, just because it's Monday and because it's the first show of the week, we'll just take a broad market look to see what's happening across the different markets. Okay, taking a look at stocks. First of all, the Dow is down 44 points, or 0.19%. The S&P 500 is down 10.58 points, or 0.41%, and the Nasdaq is down 44 points, 0.67%. And just remember that the market is backing off of the all-time high that was made last week. We saw the S&P 500 make a new closing high for the week last week, and that was very positive for the market. So it's normal for the market to at least take back some of those gains. The support in the S&P 500 is down at 25.42, and we have resistance up at 25.77. Looking at the Dow Jones Industrial Average, the technical levels on the Dow, support and the medium-term support is down at 22.95, and resistance is up at 23.320. Okay, looking at the broader market, we have a unique situation where gold is up 0.25% today, and the US dollar is up also. We have the US dollar slightly up on the day, and also gold slightly up on the day. So that is a unique situation, because gold and the dollar normally move in opposite directions. Gold found support down on the futures chart. We saw support in the 1273 region, and the market is bouncing. What gold is trying to do really is put in a longer term bottom. Well, I believe the long-term bottom has been put in already, and what we're trying to do is form a medium-term bottom between this 1300 and 1220. Anywhere around there, we should see the market really try to bottom for a longer-term type rally. And gold is at a stage right now where the rally is young still. Not a lot of folks in the mainstream media is speaking about the rally in gold. Everyone is focusing on stocks and the rally that we're seeing in stocks. So you're not really hearing a lot of media attention on gold. And that's what we like when we are building our positions. We don't like our positions, or when we are building our positions in a asset class, for everyone to be speaking about it. Normally, when everyone is speaking and hyping up something, that is the time where we want to be in the market, but we wanted to have bought that market a long time ago. And in making money in the market, it's all about timing, when to buy and when to sell. So we're I believe that gold is at a good point now. It's looking like putting on some positions in gold is would be a very good move at this point in time. Support in gold, as I said, is down 1260 down to 1220 is support, and 1200 is very strong support. Resistance is 1360 and 1380 in the gold market. Looking at the silver market, we have a similar situation with gold, where the market, I believe, had bottomed about a year and a half ago, and we're seeing a series of higher highs and slightly higher lows. Support in silver is down at $15, and resistance in silver is at $18. Looking at the US dollar index, support in the US dollar index still remains at 91 region. The market is rallying and is encountering some resistance here at the 94.26 level. And the US dollar index is kind of moving in the same direction as gold today, which is, well, as of this recording, we see the market moving in the same direction, which is not very unprecedented. And that's why you have to do analysis of each market separately. Now, looking at the stock rally, or back to the stock rally, we see that the S&P 500 is moving upwards. And a lot of folks out there who manage portfolios, who manage their own positions, are missing out on this rally. And one of the reasons why they're missing out on this rally is because of something they're saying, that the rally cannot go up any further. It cannot go up any further, and folks have liquidated a lot of their positions. And what they have seen is that the market just continues to go up and up and up and up and up. So that's why investing based on emotions, investing based on feelings, is always a dangerous thing to do. When investing, you have to invest based on rules and let the market guide you. And that's why I am not an advocate of predicting or trying to predict where a market will go. Try and predict where the top of a market is. Trying to predict exactly where the bottom of a market is. If you were following the market, following a market-led type of approach to investing, you would see that the momentum of the market is still up. And when the momentum of the market is up, you essentially should be long that market. Eventually, the market will turn around and correct, and that's when you exit the market. Allow the market to correct and come down a little before exiting the market, and not just exit the market and think that, or exit the market because you think that this could be a top in the market. That is not how it works, because the S&P 500 has been rallying ever since 2009, and every year I have heard the argument that this year it's a top. In 2011, the market was, people said that this was just, the move was just a temporary move. In 2012, the argument still, it was a temporary move. In 2015, the same thing. I remember in 2015 to 2016, there were a lot of arguments that the market was at a top. The market was kind of channeling, moving sideways, and everyone was saying it's a top, and the market continued to surge. So just be very careful when calling tops in the market. That being said, you should always have stop losses under this market, because what we could see is a strong pullback, especially from these lofty levels. The market has not pulled back in a number of months, so we can expect a pullback soon, but do not preempt that pullback. Do not try and short the market now, because that can lead to a lot of that can lead to really a lot of pain in your account. If you want some more information on the market-led approach, there's a free report there at smartinvestorcentral.com. Get that free report. It outlines the market-led approach to investing and portfolio management, and it moves away from the prediction model where folks are constantly trying to predict the market. The mainstream media is trying to predict the market. Everyone is trying to predict where stocks are going. I mean, if you turn on the TV, you hear it a lot. The so-called experts will say the market is going to top out in November, or they're going to say it's going to top out in December or January or whatever. There's an expert that is always saying the market will top out or the market will continue further. I heard an argument the other day, folks saying that it's Dow 35,000 from here. Will the Dow go to 35,000? Who knows? And that's why you just have to submit to the will of the market. Let the market guide you. So if the market is in a bull move, if this bull move continues for the next 4 years, you position your portfolio to take advantage of the move for the next 4 years. If not, if the market pulls back, you exit the position and let the market kind of sort itself out. And that is the market-led approach. Always follow what the market, yield to the market. Don't try and predict what the market is saying. And I believe that's a much better guide in your investments. More information again, smartinvestorcentral.com, and get that free report. Now, looking at, before I close the show, let's look at the German DAX, because the German DAX had surged to a record move above that 12,991, and the market is still looking fairly positive, and the trend in the German DAX is still to the upside. So that is very good for the DAX. Looking at the FTSE today is up slightly, just 0.02%. But the FTSE, the position in the FTSE is also very positive, or fairly positive, where we see the market is approaching its all-time high in May. And if this market does not close above this 7,600 level, that would be a cause of concern. And we could be in a position where it could mean a double top in the market. So look out for the FTSE. If you're along that market, look out, because if we do not close above the 7,600 level, we could see a fairly significant pullback in that market. So be on the lookout. Well, that's it for today's edition of the Smart Investor Podcast. Remember that the markets are always here, and essentially it's for you to navigate them properly to make money in the markets, because we invest in the markets to make money and not to be frustrated or not to lose money, for sure. Thank you very much for listening. If you have any questions with regards to the podcast, you can send an email to info@smartinvestorcentral.com, info@smartinvestorcentral.com. Thank you for listening, and I hope you have a wonderful day.